Hey guys, Nate here with New View Trust Company. Today we're going to touch on the proposed American Families Plan and talk about what's in that plan, how that may affect you as a real estate investor when it comes to capital gains tax laws, and how you can shelter yourself away from increased taxes by using a self-directed IRA or self-directed 401k. First, let's talk about the current law as it stands now with capital gains. If you buy and sell real estate within 12 months, you're subject to what's called short-term capital gains. Short-term capital gains currently are just your personal income tax bracket. So that could be as high as 37.5% for some of you high income earners. But if you buy and sell property within 12 months, you have to pay 37.5% short-term capital gains. If you hold property a year and a day or longer, you pay long-term capital gains. And currently, that's at 20% is the max. Now, you do have to account for the Medicare tax, an additional 3.8%. But currently, if you pay long-term capital gains, the max you would pay is 23.8%, not including your state tax. Now, let's look at the proposed American Families Plan. How does that affect capital gains? When it comes to long-term capital gains, there's a proposed increase from 23.8% to 43.4%. Now again, this doesn't include your state tax and some other taxes that might be included depending on the state that you live in. If you're a real estate investor, make sure you look this up and plan ahead accordingly. For instance, California, with the state tax and an increase in capital gains tax, you might be paying upwards of 56.7% capital gains when you buy and sell investments. Now, what is a way to get past this, avoid it, eliminate it altogether? It's by owning real estate inside of an IRA or a 401k. Self-directed IRAs at NewView allow you to buy and sell real estate, and by the fundamental rules that IRAs have since the beginning of time when IRAs were created back in 1974, is that you don't have to pay capital gains tax when you buy and sell real estate inside of an IRA. We as individuals are different. We're taxpayers. So it's not about agreeing or disagreeing with the proposed plan. It's about what do you do to avoid that increase of taxes if it comes. Real estate is a great investment inside of an IRA. You don't have to worry about paying capital gains tax. And we have those types of IRAs that we administrate here at NewView. The other thing real estate investors want to look at too is the changes or the targeting this plan may or may not make to your 1031 exchange opportunities. 1031 exchange is what a lot of real estate investors use to defer taxes by taking an investment and selling it and exchanging it for like property and not having to pay the capital gains. Basically, swap till you drop is how a lot of investors like to call that. But in the plan, obviously, they are targeting that as well in limiting how much you can defer when it comes to your capital gains. So again, all of this is proposal, but with any proposal, you want to think ahead and think, okay, how do I prepare and how do I set myself up for success so that if there is an increase of tax, I'm best prepared for it. And I think one of the best ways to prepare for an increase of tax is just set yourself up in an account that doesn't get taxed either way you look at it. So IRAs, 401ks, HSAs, ESAs, these are all plans that we administrate here at NewView Trust Company, and they are all plans that can own real estate. And every single plan you buy and sell real estate here at NewView, you'll never pay capital gains tax on. If you're interested in learning more about self-directed IRAs, owning real estate, or other type of alternative assets, make sure to subscribe to our YouTube channel. Make sure to follow us on Facebook, and make sure to visit our website for more continuing education and news from NewView Trust Company.